A devastating mortgage crash is about to hit the US housing market in the summer of 2022, and no one is prepared. In only a couple of months, we're going to start to see banks start to shut down, inventory on the US housing market surge, and as a result of all of that, a massive crash in home prices. And this is all related to how much mortgage rates are surging right now. Over the last 3 months, the 30-year fixed mortgage rate, the quote that you get if you go to buy a house and get a mortgage, has surged from 3.1% in December all the way up to 4.7% in March. That's a historic surge that has left the US banking and mortgage industry freaking out. And to get a sense of how much they're freaking out, take a look at this. Mortgage News Daily just released an article titled, 30-year fixed rates heading towards 5% at fastest pace in decades. Rates added to the record-breaking move higher today. The carnage has now earned early 2022 the dubious distinction of being the biggest 3-month rate spike since 1994. Now just take a look at the language used in that article written by someone in the mortgage industry. They're saying the carnage that's been inflicted over the last couple months is the worst it's been in decades. Clearly, people are starting to freak out who are on the lender and banking side of the equation. And the reason is this. If you were to go to buy a home 1 year ago in March 2021, the cost of your mortgage payment per month would have been about $1,170 per month. That was based off a typical home value at the time of about $275,000 and a 30-year fixed mortgage rate of 2.9%. But since both home prices and mortgage rates have surged over the last year, that typical monthly payment today, if you're going to go to buy a house, would be over $1,700 a month, a 46% increase in just 1 year. Just think about that for a second, folks. In just 1 year, the cost for you to buy a house, the payment that you're going to have to make every year for the next 30 years has gone up by 46% in 1 year. That is what's causing the mortgage industry and the bankers to freak out right now, because they know that such a big, sudden increase in costs is not sustainable and it will inevitably crash the US housing market. Because after all, to get a loan to buy a house, you need to qualify for that loan. The bank needs to look at your income and your wages and make sure that you make enough money to be able to afford the payments on the loan. And if you do make enough money, they're going to approve the loan and you can buy the house. If you don't make enough money, well, the loan's not going to be approved and you're not going to be able to buy the house. Problem is that more and more in America, people are not going to have the money and the wages to qualify for a loan to buy a house. Just take a look at this graph to see what I'm talking about. The blue line shows how much the mortgage cost, the home ownership cost, has increased over the last 12 months, up to a 46% growth rate that we talked about before, with most of that increase coming in the last 4 to 5 months. Meanwhile, the green line, the average wage in America, has only gone up by 5% in the same span. And so I think now you're all starting to see the problem that this is presenting in the US housing and mortgage market and why the bankers and the people in the mortgage industry are freaking out. The fact that in the last year, the cost of home ownership, the cost of a mortgage for you to go buy a house has gone up 9 times faster than your income. That is crazy. That is historically unprecedented, and it is a sign of a massive bubble that's about to come crashing down. And the reason we know this is because of historical data on the US housing market, which I'm about to show you. The fact that whenever we see such a large surge in the cost of home ownership in the short term, that's never really able to sustain itself. Because you can see that today, the cost for you to go buy a home at $1,700 per month for just your mortgage, that doesn't include property taxes or insurance or maintenance, just your mortgage at $1,700 a month, is the highest level it's ever been by far. It's more than double the long run average over the last 40 years, and it's more than 27% higher than the previous peak that occurred in the mid-2000s, which was the largest housing bubble of all time, which proceeded to have a massive housing crash. We're even higher than we were back then in terms of how expensive home ownership is in America. This says that it's a legitimately terrible time to buy a home right now. You are paying an upfront price and down payment as well as an ongoing cost that's higher than any American homebuyer has ever had to pay in US history. Nominally or inflation adjusted, these numbers look terrible and suggest a massive bubble. Particularly in certain markets in America, the areas in red on this map, they have the biggest short-term surge in mortgage rates way above the levels of inflation and wages, and that means that these areas in red, whether they be places in Florida like Northport, Cape Coral, and Tampa, or places in Texas like Austin and Killeen and Dallas, or places in Arizona like Phoenix and Flagstaff, or places in Montana like Missoula and Kalispell, or pretty much anywhere on the western side of the US where you see that red, that's an even worse increase in the cost of home ownership, well above the level of wages in the economy. And that means that in some point in 2022, across America, but especially in those markets in red, we're going to see the mortgage crisis and the mortgage crash take hold. Banks are going to stop giving loans to people to buy homes because, quite simply, people can't qualify for the loans. Remember that. The increase in the cost of ownership has far exceeded the increase in wages and income, which means that when the bank goes to do the underwriting and they look at the debt to income ratio, the people applying for the loan are not going to be able to qualify at today's home prices. That means home prices are going to have to go down to be able to sustain any type of fundamental equilibrium in the housing market, especially when you consider the fact that 75% of all home purchases in America use a mortgage. That's right, folks. 3/4 of all home sales in America use a mortgage to facilitate the acquisition, which means that the housing market has ridiculous exposure to this destabilization in the mortgage industry. I see a lot of people talk about the fact that there's so many cash and investor buyers and that these cash buyers don't care about mortgage rates and they're going to keep the bubble going. But it's important to remember that these cash buyers, these investor buyers, are a minority of home buyers in America. They only account for 25%. The mortgage buyers are 75%. So what happens in the mortgage industry is going to determine what happens in the US housing market going forward. Now, I think some of you might be saying to yourselves, all right, this makes sense, Nick. I see how the current market isn't sustainable given how much the cost of home ownership has gone up versus wages, but how come we haven't seen this crash play out yet? And when is it going to play out? Because an astute observer would say we've already seen mortgage rates go up now for 3 months in a row. When are we going to start to see the US housing market go down as a result and this mortgage crisis unfold? That's a great question. And when you look at the historical data, it typically takes about 6 months for higher mortgage rates to start lowering demand in the housing market, pushing inventory up and prices down. That's because at first, higher mortgage rates can actually increase demand in the housing market by causing people who are fence sitting and waiting to buy to all jump into the market at once. That's what the US housing market is going through currently. The surge in demand that occurred during the winter was due to a lot of people trying to lock in a low mortgage rate before they went up. But after about 6 months, this effect goes away. The people who decided to jump in have already jumped in, and now the housing market is left to contend with the fact that it's ridiculously expensive and there's a much lower share and amount of qualified home buyers ready to buy a home. That means I expect the impacts of these higher mortgage rates and the mortgage crash to start around July 2022. That's in about 3 months. That would be about the 6-month mark from when mortgage rates in America really started to surge. So keep your eye on that date. Now, one last question I want to address for you guys, I think it's probably on your mind, is regarding inflation. I know a lot of people are talking about the record high inflation we're seeing in America, 8% over the last year, the highest level in 40 years. How is that impacting the US housing market? And could this higher inflation continue to lead to higher home prices and growing mortgage payments in the future? And to answer this question, so you can see why the level of inflation today is not really justifying what's going on in the housing market, take a look at this graph. We're comparing the year-over-year increase in mortgage cost, which is 46% over the last year, as we talked about earlier, compared to the year-over-year increase in inflation, the yellow line, which is 8%. What you can see going back over the last 40 years is that inflation is much more stable than the cost of buying a home. The cost of buying a home is very volatile. In fact, you'll see it lurch up by 20% and then down by 12%, up by 18%, down by 17%, now up by 46%. The cost of buying a home can go up or down a lot in only a year or two, depending on what happens to prevailing home prices and mortgage rates. And the fact that we're seeing such an unprecedented surge in mortgage costs today suggests that we're going to see a decline in mortgage costs going forward based on what's happened historically. That means the historical data is saying that if you're a home buyer today, chances are your cost of buying a home is going to go down over the next couple of years. That can happen either through mortgage rates going down or home prices going down. I think we all know probably at this point it's unlikely mortgage rates go down over the next couple years given what the Fed is doing. So that leaves a decline in home prices and home values as the easiest mechanism to unlock more affordability in the housing market. Ultimately, if you're trying to make a decision about whether to buy a home today, that's a very personal one related to your personal needs and your finances. The thing to understand from the financial perspective is that if you do buy today, you are paying a legitimately record high price up front as well as ongoing costs of ownership. We've never seen costs this high before in the US housing market, and the levels of inflation and wages do not justify it, which suggests that prices are going to be coming down. If you guys enjoyed this video, please make sure to smash the like button. That's the best way you can support this channel and get this content out to more people. Additionally, make sure to leave a comment. What are you seeing in the housing market? And actually, I'm curious, have your wages and income and salary, have they kept up with the increase in housing cost over the last year? Do you feel like it's possible for you to buy a home at today's prices? The data from the US government is saying no, but I want to hear what your thoughts are in the comments section below. Additionally, also make sure you're a subscriber to this video. I come out with 3 data-driven videos per week. You're not going to want to miss this content going forward.